Good evening, everyone. Good evening, students. Uh, welcome. I welcome all of you, students, and myself, CA Rajiv Sachdeva, and with me, FR faculty, CA Shilpa Agarwal is there. Shilpa, madam.
Yeah. Hello, everybody.
Yes, students. Today, in today's session, we will be taking case study 5, and this is about a company which is ABCD Limited. Yes, any queries are there, first of all? Or
No, sir.
okay,
No,
okay.
sir.
So ABCD Limited, this is a textile manufacturing company. This is based in Surat and which has more than 50 years of good reputation and business. It has earned good reputation, goodwill in doing the business. The company was set up by Mr. Amardev in 1960s in a small room, and as years passed by, it became such a successful and big business that now, after serving domestic consumers, the company has gone global and expanding its business across Europe, Canada through third-party sales from India. So, so students, international transactions might be there in the case study because it is doing its business throughout the world. So Mr. Rahul Dev, who is grandson of Mr. Amar Dev, is MD of the company and has been following quite an aggressive approach. And he wants to make his business global. And his approach is globalization of the business after graduating, and he has graduated from a reputed college. He remains in constant touch with the chartered accountant, who is CA Nitin Garg, partner of Nitin Garg and Company, and keeps on discussing with him legal compliance. So means this company is quite a conscious company so far as legal compliance and procedures are concerned. So company is quite conscious, students. Rahul knows that complexities in business have increased a lot, particularly after advent of GST, and it becomes necessary to diversify the ever expanding business. He understands that their company is well integrated into the web of international business transactions. So students, international business transactions might be there in the case study going forward. There is inward as well as outward flow of goods and services between India and other countries. GST impacts imports and exports too. So GST might be international taxation coverage in the case study or provisions relating to export and imports in case of GST. So while you go through the case study, students, my advice is as you go through the case study, just check out which subjects are there in the case study and what sort of questions can be there following the case study. So this is very important, students. Just have a deeper understanding of the case study and think of the provisions involved, which might be there in the questions. So when you will come across questions, so your mind will be prepared for it. You understand? So you can better handle the questions. Provisions in GST law seek to provide a level playing field to domestic suppliers with international suppliers in case of imports and make exports more competitive. He has been discussing various provisions of GST with respect to its business. So this is how ABCD Limited wants to expand its business, and management has found a suitable site which meets its requirements. The said site is owned by one of the directors, Mr. D. Now, Mr. D has introduction of Mr. D is there. Mr. D was unwilling to sell his prized property to the company. The company, however, offers him in exchange a bigger. So Mr. D has one costly property, prized property, but he was unwilling to sell, and the company is looking for a suitable site. The company, however, offers him in exchange a bigger site. Though what the company is thinking, company has offered a bigger site located in an area having commercial potential. So when is having the option to have bigger property. So this attracts Mr. D and he agrees to the proposal given by ABCD Limited. A property valuer, civil engineer by profession, who is having experience of 20 years in valuing property for commercial banks, is also approached by the company for arriving at value. So a valuation, students, this is valuer. So valuation is a while you finalize. So similarly, you need to think over that whenever you are finalizing the balance sheet of a company, so valuation problems are always there in the industry across, and you need to take help of valuers for arriving at the correct values, for arriving at the true values, so that the figures stated in the balance sheet are not misstated. So this, uh, as you are aware of the concepts, auditors expert, then management's expert. So simultaneously, you should think in the direction when you come across such things like valuer. If valuer is there, so you should think over, yes, valuation could be there, and why valuers are appointed, why chartered accountants need the help of valuers, why industry needs the help of, and who are valuation experts. Even income tax department has empaneled valuers with them. So far as banks are concerned, banks have valuation experts with them. They are impaneled with them. So these type of uh, questions are very relevant. Rahul, in order to expand his business, also discusses with Nitin on setting up a subsidiary outside India at Paris for specifically carrying out the import-export transactions easily. And soon afterwards, Rahul sets up a subsidiary at Paris under the names and style of PQRS Limited. Now, another company has emerged. Another company has come into picture, that is PQRS Limited. And in order to expand his business, he is setting up a subsidiary outside India at Paris, uh, for specifically which is for specifically formed for the purpose of import export transactions easily. And soon afterwards, Rahul sets up a subsidiary at Paris under the name, and the name of the company is PQRS Limited. ABCD Limited is engaged in the business of manufacturing cloth for other textile companies and non-textile companies. Now the company will be itself carrying out the import export. Yes, Shilpa madam, can you
Yes, sir.
come to the next page?
Yes, sir. ABCD Limited is engaged in the. You are starting with that. Two lines are coming.
Import export transactions. Next page. Yes.
Yeah.
Transactions without involving any third party for export purposes, which it had been doing till now. It applies for the IC code. So students, very important, very important thing is whenever your client is entering into import export business, your client is trying to do the import from other countries, or your client wants to start export, he wants to become exporter, say मेडअप्स का एक्सपोर्ट करना चाहता है आपका क्लाइंट. तो स्टूडेंट्स इमीडिएटली आप what should come into your mind? Import export code. So import export code your client requires before doing the export and import transactions. So that is the prerequisite to become exporter or importer. So DGFT is government's full department government has set up for the purpose, Director General Foreign Trade, DGFT. So some chartered accountants, I know some chartered accountants are there who are doing only DGFT business. They don't do income tax business. They don't do GST. They don't do accountancy. Only DGFT business. So many things are related. Exporter, importers, because incentives are there. When you export the goods, incentives, lot of incentives government is giving, and the uh, chartered accountant gets the relevant incentives to the exporter and gives his services so far as the export incentives are concerned. So this is very, you see, lucrative area. Earlier it used to be very lucrative area for chartered accountants, but now some more issues are there. So I see, what I mean to say is that DGFT deals, Director General Foreign Trade deals in, from that office you can have import export code number. It is wholly owned subsidiary of PQRS Limited. Its wholly owned subsidiary PQRS Limited is engaged in the business of ready-made designer garments, which is formed in Paris. The subsidiary purchases garments and other stuff from its parent company. The demand for garments of PQRS is very high and has to cater to its shortfall. PQRS also purchases garments from other companies, not only from its holding company, it is also buying from other companies. Purchases are made at competitive prices. During the year 23-24, ABC Limited sold garments to PQRS Limited for 13 lakhs euro on 1st January 24. Up students, the moment you come across foreign exchange transaction, immediately which Indias comes to your mind? Please tell me. Which Indias comes to your mind? Yes, students, I am waiting for your response. Yes, Shilpa madam, are students responding or not?
As of now, for this particular question, we are still waiting for the response.
Okay. So students, Indias, uh, of course, CA final, in CA final you have studied FR. So India's 21 is there, students. So India's 21. Now immediately the point which should strike in your mind, the question can be related to India's 21 in the case study. The cost of these garments was rupees 93 lakhs in the books of ABCD Limited at the time of sale. At the year end, all these garments were lying as closing stock with PQRS. Euro is the functional currency of PQRS, while Indian rupee is the functional concept of functional currency, concept of foreign currency, and concept of presentation currency. So this you should be conceptually very much clear about the basic concepts of India's 21. ABCD Limited seeks help from Nitin on the following issues. Now, Shilpa madam, will you like to take question till now or you will take question afterwards?
I'll do that, sir. I'll take it up because we are
Okay.
discussing the issue right now. Let student discuss on this only first. So this question, as sir already informed, that when foreign currency is involved, standard which comes to our mind is Ind AS 21. So here for Ind AS 21, we have a transaction here, a company ABCD Limited is a parent company here, and it has purchases, ABC Limited, the parent company, has sold garments to PQRS Limited for euro 13 lakhs. As sir told, function currency of PQRS, that is a subsidiary company, is euro, while the functional currency of your parent company is your rupees, Indian rupee. So where there is a difference between the functional currency of parent and subsidiary, or the buyer or the seller, definitely there comes into the picture is foreign currency exchange transaction. So here, if we go through the question part of the this case study, we'll find that Two exchange rates have been given in the question part. Let's go to the first question part here. Question number 6 belongs to this particular scenario of this case study. Provide the accounting treatment with respect to transactions between ABC Limited and PQRS Limited in their respective books of accounts. So, in the individual financial statements of parent company ABC Limited and individual financial statements of subsidiary company PQRS Limited, we have to provide the accounting treatment for this purchase and sale and what the event is. Also show its impact on consolidated financial statement. Consolidated financial statement means group entity. For group entity, we have to find out the accounting treatment, what is to be done there, what are the adjustments which has to be taken place in the consolidated financial statement. Support your answer by journal entries. So this is one step. Support by journal entries wherever necessary in the books of ABC Limited. Following additional information is available. Exchange rate on 1st January 24. This is the date on which transaction between parent and subsidiary company took place. So 1st January is the date on which transaction took place. So exchange rate of that particular date has been given in the question part. Similarly, now because these goods are unsold, kept still unsold in the books of subsidiary PQRS Limited. Therefore, exchange rate of the reporting date, that is 31st March 2024, also comes into the picture. We require that also, because when a company is purchasing or selling to another entity, definitely, and that transaction is not in cash, it means it involves trade receivable or trade payable. For the entity which is selling for them, the another entity is a trade receivable, and for the entity which is purchasing is for them, the other party is the trade payable. Okay, so these trade receivables and trade payables are monetary item, and when there is a monetary item involved, we need to translate that in the in your books, because your subsidiary parent company is having a different functional currency than your subsidiary company. So transaction is also in a different currency. In that case, we need closing rate or spot rate of the reporting date for translation in the functional currency. It means the reporting date is 31st March 2024. So we require spot rate of 31st March 2024 to translate the monetary items in the financial statements as per the functional currency. So for subsidiary company, the functional currency is for subsidiary company, the functional currency is euro. Transaction has also taken place in euro, but for parent entity, when they are preparing their individual financial statements, they have to translate each and every transaction in Indian rupee, which is their functional currency. Okay, so since in purchase of goods and services, we got two dates. One is on 1st January, that is 1 euro is equal to rupees 83, and on 31st March 2024, that is on reporting date, 1 euro is equal to 85. We have to remember these two rates, because when we solve the question, we have to use these two rates. Both the rates will be used. Where on which date, when it will be used, that we'll see while solving the question. So first, let's move on to the question again. Okay, another question is, ABC Limited sold garments to PQRS Limited for euro 13 lakhs on 1st January 2024. So the transaction date is 1st January 2024. So first entry will be done or posted on 1st January 2024. The cost of these garments was 936 lakhs. This is the cost value. Cost of these garments was 936 lakhs in the books of ABC Limited. Definitely for ABC Limited, who is selling, the cost is 936 lakhs at the time of sale. It means your subsidiary company is not aware of the cost. They only know that the inventory for them is cost at rupees euro 13 lakhs. At the year end, 31st March 2024, all these garments were lying as closing stock. It means these have still not been sold by subsidiary PQRS Limited. Euro is the functional currency of PQRS and Indian rupee is the functional. So first entry is to be taken place on 1st January 2024. Simple entry. whole sub parent company is selling, then in case what will be the entry? It will be trade receivables to sales. When it is trade receivables to sales, who is the trade receivable here? The trade receivable is the subsidiary, that is PQRS Limited. Okay. So trade receivable is PQRS Limited, and what is the value of transaction? That is euro 13 lakh. However, we are passing the entry in the books of parent company, in the books of ABC Limited. And when we are passing the entry in the books of parent whose functional currency is rupees, it means this transaction is also to be showed in the form in rupees. So it should be 13 lakhs. And what should be the rate of translation? That is the rate on which was there on the transaction date, and transaction date is 1st January 2024. And if we remember, when we were going through the question part, we found 1 euro is equal to rupees 83. So this 13 euro is to be translated by rupees 83 on the at the time of initial recognition, that is on 1st January 2024. Similar, same value will be here only. So 13 lakh into 183 comes to your rupees 1079. So 1079 is the rupee value of the goods sold. Okay. Sorry. Okay, students. So this entry will be 1079, 1079. Okay. I hope it is visible to you when I am writing over the question only. So your first entry at the date of transaction, that is on 1st January 2024, is trade receivable, which is more specific is PQRS Limited. This is the name of the entity which is buying it or to whom we are selling it. That is PQRS Limited. And the value will be your 1079 rupees lakh in rupees in lakhs, because this 13 lakh euros have been translated into Indian currency by rupees 80, taking the spot rate of 1st January 2024, that is rupees 83 per euro. Okay. So this is the entry on 1st January 2024. Now comes in the same books, that is in the books of parent company or ABC Limited, we have to also pass an entry on 31st March 2024. That is the reporting date. And on reporting date, this entry is still there, but now the value of this transaction has changed. Now the value of 1 euro is 85 rupees per euro. So in that case, we have to see the difference. What is the gain or loss on this particular transaction, which will be gaining at the time of settlement. So right now on the date of reporting date, this value is now increased to 85. So the difference of 85 minus 83, that is 2 rupees per euro gain into 13 lakh euros. Okay, so 13 lakh, it comes to 26 lakh rupees. So our entry will be again our trade receivable, which is a monetary item that is being increased. So we'll again increase the value of this trade receivable, because now we'll be receiving 2 rupees per euro more than what we were receiving on the date of transaction. So again, this value will increase. So our debtors will increase, or our trade receivables will increase. So this will be 26 lakhs, 2 into 13. 26 lakhs 2, and this figure will move to which account? This will move to foreign exchange difference. Okay, which is your unrealized account. But on reporting date, we have to bring all our monetary items at the closing rate, that is the spot rate of the reporting date. Therefore, the difference is by difference, whatever there is a difference of exchange, foreign exchange from the historical date, or that is from the date of transaction to reporting date, that is to be accounted for on the reporting date. So accordingly, this 26 lakhs have been accounted on 31st March 2024. These are the two entries which will take place in the books of parent entity who are selling the goods. Now, what comes is in the books of subsidiary company, because as per the question, we have to pass accounting entries in three books. First in the books of parent entity, then in the books of subsidiary entity, and third in the books of consolidated, that in the group entity. Okay. So in the books of group. So in the books of subsidiary, that is PQRS limited books, what will be the entry? The entry will be only one because the transaction has taken place in the currency which is their functional currency as well. The functional currency of PQRS subsidiary limited is euro, and the transaction has also taken place in euro. So only one entry, and that is on the date of transaction, that is 1st January 2024, will be simply purchase DR to trade payable, and trade payable is ABCD Limited. Okay. And what will be the entry? 13 lakh euros. Okay. So this will be the entry in the books of subsidiary company on 1st January 2024. Now this 1st January 2024 entry, on closing date, your functional currency is euro and you will be paying in euro only. So there is no change. So therefore, on reporting date, nothing is to be accounted for. So, okay, you have to pay 13 lakh euros on 1st January, and same is the situation on 31st March also. Still, you have to pay 13 lakhs euro, irrespective of what is the for translation rupee value of each euro, but you have to pay 13 lakh euros on 1st January, and that situation is continuing till 31st March also. So no entry has to be passed on 31st March 2024 in the books of subsidiary company. Reason behind is that the functional currency and the currency of the transaction is same. Okay. Now comes in the picture is your consolidated in the books of group. In the books of group, as we know that mutual transactions are eliminated, and when mutual transactions are eliminated, it means trade receivable of ABC Limited will be deleted from the will be removed, and similarly trade payables of PQRS Limited on consolidation will be removed. That will be eliminated. And when they will be eliminated, it means there will be no trade receivable or trade payable in the book consolidated financial statements with respect to this transaction. Okay. Similarly, any purchase or sale, that will also be eliminated. Purchase in the books of subsidiary company and sale in the books of parent company, when they are consolidated in the books of your group entity, there will no purchase and sale with respect to this particular transaction. However, when it comes to exposure of foreign currency, that exposure has to be recorded in the consolidated financial statement. The reason behind is that on consolidation, any related foreign exchange gain or loss will not be eliminated, and this is because the group has a real exposure to a foreign currency, since one of the entities will need to obtain or sell in foreign currency in order to settle the obligation or realize the proceeds received. Okay, so there is a gain loss there, but that gain loss is on account of foreign currency exposure, and that is required to settle down. So that has to be reflected in your consolidated financial statements as well. Okay, so what will be the entry in the books of subsidiary that we have to see? See, now when it comes in CFS, in books of CFS, first of all, we have to understand what is to be eliminated. Only gain or loss is to be eliminated. Only purchase and sale and trade and receivable and trade payable will be eliminated, but your exchange gain or loss is not to be eliminated. So first we have to find out what is the gain or loss. Okay. Second thing is, the second part which is to be eliminated is the unrealized profit. Unrealized profit is to be eliminated. So first here, this entry will be not eliminating this gain or loss of this 26 lakhs which we are having here. However, the unrealized loss which is there when we are selling the goods for 13 lakh euros, if you go through the question, you will find the cost of the inventory or the goods was mentioned as 936 lakhs. 936 lakh was the cost for your parent entity. So when it was sold to 13 for rupees 13 lakh euros, it comes to 1079. So what was the gain which ABC Limited got at the time of sale of this good was 1079 minus 936 lakhs, which is the cost of the goods. So the difference is your 143 lakhs. This is the unrealized profit. Why this is unrealized profit? Because the goods are still lying with the subsidiary company on reporting date. So this is unrealized gain, and this unrealized gain is to be eliminated in your CFS. Okay. So you're in a consolidated financial statement. This gain how will it be eliminated? It will be eliminated through consolidated P&L. Okay. Consolidated P&L 143 lakhs to your inventory. This unrealized gain ultimately reduces the value of inventory. This inventory is in whose book? This is inventory is showing or reflecting in the books of subsidiary entity. And in subsidiary entity, the cost is mentioned as 1079. However, for a group, the cost is only 936 lakhs. But when we are consolidating line by line items of your balance sheets of parent and subsidiary, we found 1079 as the value of inventory in the books of subsidiary. That 1079, when brought to consolidated financial statement, we'll also check out from whom it has been purchased. It was purchased from parent entity, and for parent entity it was 936 lakh. If that good was sold, no issues, it is a realized gain. And when it is a realized gain, definitely no need to, it is realized, so no need to eliminate it until and unless this transaction is contra transaction, or we can say mutual transaction. When it is sold to third party, it does not remains as a mutual transaction. It becomes the transaction to the third party. However, since it is unsold on reporting date, it means it is not sold to third party. It means it is still a mutual transaction. So gain with respect to mutual transaction will be eliminated. So this 143 lakhs in rupees, where let me explain you students. When we are preparing consolidated financial statement, functional currency will be the currency of the parent entity. And here the parent entity is ABCD Limited. And the functional currency of ABCD Limited is rupees, Indian rupees. So your consolidated financial statement will also be prepared in Indian rupees. And when it is to be prepared in Indian rupees, so we'll find out what is the gain which was recorded in the books of parent entity with respect to this transaction in rupees. And in rupees, it was having 143 lakhs. So sale was for 1079, purchase was for cost was 936 lakhs. So the difference of 143 lakhs, which is unrealized gain, will be eliminated. Okay. Trade receivables and your trade payable will be eliminated. Similarly, purchase sale will be eliminated, but that 26 lakhs, which was the gain, that will not be eliminated. However, 143 lakh is the gain on unrealized gain, which is still not realized because it was not sold to the third party, that will also be eliminated. So this 143 lakh has also been eliminated. Okay, one more aspect is that when we are preparing consolidated financial statement, we have to do certain revaluations also. When it comes from the perspective of consolidated financial statement, there it comes the valuation of inventory. As per Ind AS 21, when any transaction is done, depends on comparability of two monetary items on the reporting date. When your valuation depends on two amounts and comparison of two amounts, based on that you have to find out one value. At that time, we have our standard in Ind AS 21. It is specifically mentioned. If we go through the bare text of Ind AS, you'll find para 25A and B. However, if you go through the study material, you will find in page 9.103 of your study material, 9.104 of the study material, where it is mentioned that in case some carrying amounts of items is determined by comparing two or more amounts. for inventories where impairment is involved. There also comparison is between the carrying amount and recoverable value. At that time, we have to find out the two values on two different dates. First is historical cost value, that is the carrying value on the historical cost, which was 13 lakh euros translated by 18 rupees. Let me go through the answer and there we can find out what is there. Na? Okay, if we go through the answer, we just find it out there. So in the books of consolidated financial statements, we are seeing cost is on historical data. This is on 1st January 2024. This was the cost 13 lakh euros and translated at the initial or historical date or historical transaction date, and that is comes to 1079. Now, on reporting date, we go for net realizable value. Why? Because Ind AS 2 says inventories are valued at cost or NRV, whichever is less. However, in the question, NRV is not mentioned. So we'll assume that whatever was the cost on 1st January 2024, that same cost is being continued on the reporting date, that is on 31st March as well. And when on 31st March 2024, same cost where NRV value is continuing, but your foreign exchange rate, spot rate has changed. So we have to translate NRV on the reporting date, and reporting date, the transaction value of 1 euro was equal to 85 lakhs. So our value comes to 13 into 85 as 1105 lakh rupees. So on comparing these two figures, we find cost to NRV, whichever is less, here cost is less. So no changes are to be made in the writing off of inventory. Our inventory, which was carrying in the books of subsidiary, or in the which was carrying on translation from the books of subsidiary, that will continue. That application of Ind AS 2 as per Ind AS 21 will not be done. No write-off will be done. We'll do the application, but write-off will not take place because your cost out of cost in NRV, your cost is less. So we'll continue with the figure which was appearing in the books of subsidiary. Okay, that is 1079 lakh. That is on transaction date because it's a non-monetary item, and non-monetary items are carried on historical cost. So cost is 1079, but because it is inventory, we have to apply Ind AS 2. There is specific standard for that, and as per standard, it is cost or NRV, whichever is less. NRV is to be measured on the reporting date spot rate, and reporting date spot rate is 85 rupees per euro. So after translation, we get 1105 as NRV, which is higher than cost. So inventory will continue at cost, that is 1079 lakhs. Okay, students. So now we have covered all the aspects. Let me just brief it again, summarize it again. There are two concepts which are involved. One is at the time of consolidation, when we are having any non-monetary item which has been intercompany transaction, which is a result of intercompany transaction, we Ind AS 21 says for valuation we has to refer the relevant standard, and here the relevant standard is Ind AS 2 because it involves transaction involves inventory. Cost or NRV, here cost will be on the basis of the historical date, that is the transaction date, while NRV will be based on your reporting date. So reporting date means the translation will also be on the basis of closing date or reporting date. Okay, so based on that, comparison is done, and according to that, whatever value comes will be reflected in your CFS, first part. Okay, and the second concept which lies here is that in the books of unrealized gain, which is there, which has to be eliminated. Okay. So students, I hope this part is clear to you. Let me see in case any student has some queries. Students, we are not having any query, but Mansa, you have raised one question which relates to FR study material. However, this session is related to integrated business solution. I remember I got your query in your ask your query, that is BOS mobile app, and I'll be replying you tomorrow for this. So, but this is not the platform to reply the questions raised on financial reporting study material. So I have noted your query. I remember it is there in your ask your query also, and I'll be replying there also. So right now I'm not discussing this here. And okay, Shankara Rao is asking, the case study is different from what was available in the website. Sir, I hope you'll be able to reply this. They are saying whatever the case study which we are sharing on the screen is different from
Yes.
what is there on the website.
Yes, it is there on the website and it is case study 5.
No, but sir, they are saying that whatever we are sharing on the screen is not the same case study which has been web hosted.
No, it is the same one. It is the same one.
Okay, student, it may be that you just please recheck from the website. This is the same case study which has been web
It is the
hosted.
same case study.
Okay, case study 5 of the web hosted case study. This is case study 5 which we are discussing today. Okay, so over to you.
Thank you, Shilpa madam. Thank you for giving words of wisdom about FR and explaining beautifully about Ind AS 21.
I'll
think
just come back to the part where you were discussing the case
Okay.
scenario, so that it will be easy for you to start.
Yes, of
Continue
course,
from there.
Thank you, Shilpa madam.
Shall I just remove this, sir?
Nisha madam has joined.
Nisha. Coming, sir. And by the time you start with it, she's coming, sir.
Okay.
I'm just
Yes.
removing this part, sir, so
No
that
problem.
Nisha can do it.
Right.
Nisha has come, sir. You can start with this. Okay.
Okay. Yes, students, going further, this is you have completely understood the concepts involved in respect of Ind AS 21, and going further in the case study, students, ABC Limited seeks help from CA Nitin on the following issues. Now the issues which are there. Number 1, during the year, Rahul is finding it difficult to comprehend the GST taxation with respect to export sales made by their company, ABCD Limited, which are of a peculiar nature. One such sale is where ABCD Limited receives an order to supply goods to a dealer B in Greece. The company finds the supplier C in Singapore and asks him to supply goods to B in Greece. Two invoices are raised here, one by the company on B in Greece and the other by C in Singapore on the ABCD. The point to be noted here is that goods do not touch the Indian shores. They are shipped by sea from Singapore to B in Greece. So there are many more such kind of export sales, and Rahul seeks C. Nitin's help in getting out of this confusion. So question might be there instead of GST. Students, so on this particular transactions, the relevant provisions are, Shefali madam will discuss the relevant provisions of GST in respect of these transactions. So we have with us Nisha madam, Anisha Gupta, who is faculty in law, and she would be discussing about the questions which are involved in respect of law part. Yes, Nisha madam.
Thank you, sir. Good evening, students. Yes,
Yes.
already the facts have been very well explained to you by sir. And now looking forward towards the law portion. If you see,
No, I didn't right away. The law portion has gone, or it is about to come.
the law portion is being dealt under the paragraph number 3. And that is MCQ number 4.
Right. No problem. You can take it, Nisha madam.
Thank you, sir. Thanks.
You can take it.
Dear students, as already told to you that paragraph number 3 is being dealt with the law part. If you see the paragraph 3, basically, paragraph 3, yes, it says here that ABC Limited want to expand its business. Okay, the ABCD Limited was wanting to expand its business. So what happened? The management has found a suitable site in order to just fulfill its business to meet its requirement. The said site is owned by one of the director of the company, that Mr. D. However, Mr. D was willing to sell his prize property to the company. So the company, however, offers him in exchange a big site located in the area having a commercial potential. So lured by such offer, Mr. D agrees to the above. So here what happens? The property, which was the site, the suitable site which was taken for meeting up the business requirement, that property was being valued by a property valuer, civil engineer by profession. So his qualification, his experience has been shared that he has having an experience of 20 years in valuing the properties for the commercial bank, and also approached by the company for arriving at the value of the assets. So the valuer does not possess any other registration or the accreditation. Means only his expertise of the experience basically he is given that he has the experience of 20 years in valuing the properties. And on the basis of that experience, he has valued the property. So now if you see what the MCQs 4 talks about, this is the relevant para. So after reading the para, you can easily make it out that it is talking about the assessment of the property. Here, an arrangement has been made by a company with respect to purchase of a property. So that property was a suitable site, and that site has been provided that it has been valued by a property valuer who was having an experience of 20 years. Only that much information related to valuer is provided over here in the case study. So moving to the MCQ number 4. Now let's see what MCQ 4 is asking about. What is its requirement? Yes. Now MCQ 4 says that considering transaction with Mr. D, one of the director of the company, which of the following statement is the most appropriate? Since nothing has been provided, nothing has been specified what is the value of the property, only with respect to the valuer, the experience has been provided. So it clearly make it out that there is no any kind of cash transaction has been made over here. Only with respect to the assessment of property has been asked about. That is only the arrangement or the transaction has been made over here by the company. So we can make it out with the relevant information given in the case study that this case study pertains to section 192. Section 192 of the Companies Act. So what section 192 of the Companies Act talks about? It talks about the restriction on non-cash transactions involving directors. That means if any non-cash transaction have been made by the company which is involving its directors, then what are the relevant compliances that need to be performed for making such an transaction to come into an enforcement or to bring into its legal validity? So that has been provided under section 192. So basically section 192 provides the manner in respect of regulation of arrangement between a company and its director. With what? In respect to the acquisition of the asset of consideration other than cash. This is the crux of the section 192. So here the payment shall be with the usage of the instrument which uses no money in the physical form. That means non-cash transaction will be there other than the cash. Okay, so these are the expenses that are basically listed in an income statement that do not involve cash payment. This is the meaning of non-cash transaction. So you must be aware of it because since you are a final level student, so you must be very well aware what is a non-cash transaction. So in the one liner, I've explained you these are the expenses that are listed in an income statement that do not involve cash payments. Got it? So for example, you can take of non-cash transaction in a way, if suppose you go into a mall and you purchase something for your, suppose since yesterday was a Valentine Day, something for you can say for any your beloved one, whether it may be your parents, your sister or your better half, anyone, not better half exactly as of now, but yes, for anyone. So there if you purchase something from a mall through the payment made from a debit card. Here the debit card will function the same as a cash as it makes the payment for the purchase of any item immediately from your bank account. So this is a cash transaction. So because here something has been made in the form of the cash. If this is done in other way around, then it will be a non-cash transaction. There will be no any kind of transfer made in the money in the form of the money. There will be no involvement of any usage of money in physical form. So that will be a non-cash transaction, and this was the example of the cash transactions, how it takes place. So now let's see what section 192 talks about. Section 192, if you see, in a simplified manner, it could be understood as any company, this is company, okay, any company shall not enter into any arrangement by which there are two options by which director of the company, either of the same company or of its holding company or of its subsidiary company or of its associate company. Okay, of its associate company shall acquire or is to acquire any asset for consideration other than cash from a company. Okay, this is a one situation where we are saying that company shall not enter into such an arrangement by which director, or you can say any person related to the director of the company, of its holding company, of its subsidiary company, or of its associate company acquires, okay, acquires or is to acquire any asset as of consideration other than cash from a company. So means director or any other related person. This is a one situation. Or the other situation will be a vice versa. What does it mean, vice versa? Means in this case, a company who acquires or is to acquire asset for a consideration other than cash from a director or any related person of the director, then that will be a this will be considered as a arrangement which is generally a prohibited with respect to non-cash transactions. However, further the section says that there is a condition. There is a condition when this arrangement is feasible, when this kind of transaction is feasible. So it says that yes, it's possible on the prior approval by a resolution passed in the general meeting, such an arrangement can be accorded. Though such an arrangement is not allowed, but yes, there is a restriction has been marked. It is not possible. However, it is not prohibited. That means it can be done, but there is a certain requirement, and that is the requirement of seeking approval. That is on prior approval by a resolution passed in a general meeting, such an arrangement can be accorded. However, the notice for the approval of the resolution by company shall include the particular of such arrangement along with the valuation of the asset, which shall be duly calculated by a registered valuer. That means there will be a person who will be just making the valuation of that asset or the property which has been purchased. Okay, so that property will be valued, proper value of the property will be given, as well as detail of such an arrangement will be given in the notice which is served with the resolution passed by the company for its approval. And in case if any contravention is made in such a compliance, then such a contract is voidable. Voidable at the instance of the company. Company has got a right either to declare such an arrangement as a void or to consider it as a valid. So it is the company, if finds that there is a non-compliance of any of the provision of section 192, then in such a case, it will be declared as voidable. And it has been said, yes, if there is a possibility of the restitution, then the property can be, they can be indemnified. If there is any, they can be restored back to the position. But yes, that restitution is also being not possible in certain cases. There is no remedy available if suppose the company has been indemnified by any other person, okay, with respect to the loss or the damages. And if suppose any third party has acquired any bona fide right for value, that too without the notice of such an contravention, then in such case, no such agreement can be declared as voidable, and in that case, no restitution is possible, and that agreement will be considered as valid only, and there will be no remedy available to the company. But if this is not the situation, then in that case, if these two situations has not taken place of the restitution, where it is not cannot be exercised the right of the restitution, then in that case, yes, the company can declare it's voidable. So this is simply about the section 192. 192 is though seems to be not of much importance, but yes, considering it is a part of the Companies Act, and yes, whenever any non-cash transaction take place, how the company and its director plays a role in such an arrangement, then at that time, the compliances as well as this portions becomes a relevance and of importance. That is why the knowledge of section 192 is also necessary for the students to have the understanding. Since in the question and you have seen that it has prescribed about the valuer experience, just only it has mentioned that it has the experience of 20 years. Rest nothing has been specified about its education or this qualification or the experience. So considering now let's see what is the option given over here, because when we talk about the registered valuer, there is a section 247 in the Companies Act which deals about the registered valuer plus its respective rules that has been specified, which prescribed about the requirement of the qualification as well as experience for being a person as a registered valuer. So it is being said that the registered value should be registered under the Insolvency Board of India, Insolvency and Bankruptcy Board of India, IBBI. So it's a required that such registered valuer should be registered under IBBI. This is the basic requirement for being a registered valuer. So you must be seeing here, since nothing is specified, and now looking into the light of this specification of this section 192 as well as the section 247 as well as respective rules. Now let's read the given option over here and let's see which is the most appropriate answer in terms of the requirement of the question. Since the question is asking about which of the following statement is most appropriate, so let's see which is what are all the options given over here. The first option talks about the transaction with Mr. D is permissible, subject to the condition laid down in Companies Act 2013. However, the company is not acting in accordance with law by approaching a valuer referred to into the description. Such a valuer needs registration from the Institute of Actuaries of India to act as a valuer. If you see, the first line is appropriately right. The transaction D is permissible subject to certain condition. Yes, that is with respect to the seeking of approval part. If the approval compliance is being done, then the transaction is feasible. But however, the second part given with respect to the valuer, it says that such valuer needs registration from the Institute of Actuaries of India to act as a valuer. So this is incorrect because already I have specified there is clearly specified in the rules related to the registered valuers that he must be registered with the IBBI, that is the Insolvency and Bankruptcy Board of India. Since here the registration mentioned is with respect to the Institute of Actuaries of India to act as a valuer is altogether wrong. So this is why option A is incorrect. It is not the correct statement. Moving to the next option, the transaction with Mr. D is permissible subject to certain conditions laid down in the Companies Act. Again, yes, the first line is correct. But when we come to the second part of this statement, that the company is acting in accordance with the law by approaching a valuer referred to in the description. If you see, the company is in accordance with law. Nothing has been specified over here in the case study, and the law prescribes about his registration under IBBI, that is not specified over here. So again, this is a wrong option. Moving to the third option. The company or the transaction with Mr. D is permissible, again subject to certain conditions laid down in the company. The first statement is yes, correct. But however, again leading to the second statement that company is not acting in accordance with the law by approaching a valuer referred to in the description. Such a valuer needs registration from IBBI to act as a valuer. Already said that this seems to be the correct answer. But let's read the option D also. Option D talks about the transaction with Mr. D is permissible subject to certain conditions laid down in Companies Act. However, the company is not acting in accordance with the law by approaching a valuer referred to in the description. Such a valuer needs registration from the Institute of Engineers. The yes, this is the wrong because clearly defined. The yes, accordingly, The option C is the most appropriate. It is altogether appropriate. It is the correct answer, in fact, because there the valuer is being required to have a registration in the IBBI to act as a valuer. So accordingly, as per the requirement of section 192, non-current transaction is there. And since for its valuation, we are being required to have the valuer to assess the, the value of the property, and to be a registered valuer for valuing the property's value. So here he is required to be a registered valuer under the Companies Act, which is being dealt under section 247, read with the respective rules, and rule specifies that he needs to be a registered, or he should have a registration from a IBBI to act as a valuer. So since you can see how much connection is there, first you need to find out that is it related to what? It's related to section 192. So you'll be confused, oh, this question is pertain to 192. But no, again in the 192, there is the clause, yes, the valuer will be there. And that valuer is defined under section 247. And 247, if you see under section 247, then you will see the respective rules. Respective rules talks about its education, qualification, and experience to be a valuer. So altogether, this is a very good question. If you see, in order to have how the laws are integrated, how the laws are connected with each other, this is what the IBS is also about, how the different subject has been clubbed over here, just for your understanding, and how you can correlate each and everything just by going through having the understanding of the subject and solving these case studies which are available with you, dear friends. And really, this is a worth whatever the class is being given over here, whatever the case studies are being presented before here, to make you to enlighten you how everything is being connected. So in that way, let me see if I have any query. Let me take the query also. Yes, Srinidhi is asking about the law portion which is being discussed is alone not available in case studies 5. Dear student, if you see that I have already read the paragraph 3rd over here. It is talking about non-current transaction, how a property has been purchased for the conduct of the business. Okay, and that for that purpose, the property that has been purchased has been valued. So if you see, it is altogether related to the 192. 192 also talks about the same thing. Okay, and it also talks about whenever a notice is being passed for seeking the approval for said act, for said arrangement of the transaction, you required to make the valuation of the property also. So that way it comes under this, this scope of this particular section. And further, how this further related to 47 is being already explained to you. I suppose this is clear to you, Srinidhi Krishna. And I suppose that your query is also being resolved. That way it is being covered and it is being related. The content of paragraph is different on the web hosted on the material.
What students are saying?
Sir, the Srinidhi is saying that the content of para 3 is different on the web hosted material.
Para 3?
Yes, sir.
I will check it up, and if there is any difference, I will take care of this.
Because this is something I have
I will
from
take
the
care of
website
this,
only,
Nisha,
sir. So
Nisha madam, no problem.
Because this is case study which is taken from the website itself. This is, so I suppose there must be some kind of, let's check out, sir, what Srinidhi is marking. Whatever she's saying, let's see.
We will check and then revert back to the students.
Okay. And then Devraj is asking what that I'm leaving the class because I'm not feeling well. Okay, Devraj, it's okay. Take care of yourself.
And you can attend the lecture when you are feeling good and
yes, because the recorded lectures are already available. You can watch anytime. You can see anytime at your convenience. So with this, I would like to say that this question is clear to you. And now over to sir.
Nisha madam?
Yes, sir.
Can you go to the audit part questions?
Sir, sir, I need, okay, sir, I'll just do it, sir. But sir, I have to leave. Again, I have to go there.
Okay, you can leave, but you just...
okay. You tell me, sir, which part I need to go.
Put the screen on. Answer of question number. Just show the students question number 7. Then you fix the screen at the answer of the question number 7. As
Answer?
regards transaction with Mr. D, one of the directors, state few audit procedures pertaining to transactions to be performed by CA Kritkar. Discuss probable purpose of such audit procedures also. So, transactions, non-cash transactions, as Nisha Madam has explained in detail about non-cash transactions. Now we will discuss the audit procedures, relevant audit procedures relating to section 192. So students, yes, Nisha Madam, you can leave if you want.
Yes, sir. Thank you, students. Thank you, sir. Thank you.
Okay. Yes, students, the transaction with Mr. D, director of the company, is in nature of non-cash transactions referred to in section, as Nisha Madam have explained in detail, section 192 of the Companies Act. So audit procedures in this regard will include obtain management representation, written representation as to whether the company has undertaken any non-cash transactions with the directors. So students, written representation, as you all are aware, written representation, SA 580 is there. SA standard on auditing, 580 deals with written representations, and written representation SA 580 deals with the auditor's responsibilities to obtain written representations from management and where appropriate those charged with governance. So written representations are an important source of audit evidence. Written representation are an important source of audit evidence. So about this, if I am talking of point number 1, this is about SA 580. Obtain management representation as to whether the company has undertaken any non-cash transactions with the directors or persons connected with the directors. So, as envisaged in section 192(1) of the Companies Act, the auditor would need to corroborate the management representation. Now he will further investigate. He will further find out the truthness of management written representation with sufficient appropriate audit evidence. Sufficiency is the measure of quantity of the audit evidence. It is sufficiency, and appropriateness is measure of the quality of audit evidence. So sufficient, appropriate, and what is audit evidence? Students, audit evidence is the information used. Audit evidence क्या होता है students? It is the information used by the auditor in arriving at the conclusions on which the auditor's opinion is based. So students, from management, from written representation, he has got about, he will take written representation from the management as per SA 580, and it is the, what is the objective of the auditor? In accordance, if you go to the objective of the auditor, which is there in SA 580, to obtain written representations from management and where appropriate those charged with governance, that they believe that they have fulfilled their responsibility for the preparation of the financial statements and for completeness of the information provided. It is very important that it is in support of other audit evidence. So audit evidence, students, it should be sufficient and appropriate audit evidence. So if you go through the essays at final level, you are doing auditing. So sufficient and appropriate audit evidence is in respect of every essay. You will read this line. You need to write in the examination also. So this is very important aspect of any essay. The auditor has to obtain sufficient and appropriate audit evidence. The auditor should, second point is, the auditor should check compliance with section 192 of the Companies Act. And about compliance part of section 192, Nisha Madam has explained to you in detail about section 192 of the Companies Act. And auditor shall verify the compliance, how management has, the auditor will go through the relevant audit evidence the auditor will obtain relevant audit evidence which will show to him about compliance with section 192 of the Companies Act, and he will verify the notice of the general meeting that it includes particulars of arrangement along with the valuation of assets, value of assets involved in such arrangements. What are the non-cash, if there are non-cash transactions with the directors, so he will go through the valuation of the assets, what was the valuation involved, and he will also see the valuation is done properly by the valuer or not. So many evidence the auditor will collect, because non-cash transactions maybe if the auditor has to report also in the CARO. As you all are aware that in CARO also auditor has to report about non-cash transactions with the director. And the said, देखो third point, see the third point is the same point which I am explaining in point number 2. The said value of assets should be calculated by the registered valuer in compliance of companies registered valuers and valuation rules 2017. The purpose of performing students such audit procedures would be reporting requirements for non-cash transaction under clause 15 of paragraph 3 of CARO 2020. And the said clause requires the auditor to report whether the company has entered into any non-cash transactions with directors or persons connected with him, and if so, whether the provisions of section 192 of the Companies Act have been complied with. So students, wherever related parties transactions are there, wherever non-cash transactions with directors are there, so you have to be very cautious as an auditor, and you have to obtain the relevant audit evidence, because you have to report in CARO. It is very important requirement, in particularly in respect of non-cash transaction with directors. And please note, students, that valuation of the assets will be very much relevant over here, because valuation concerns are there in financial reporting. Valuation concerns are there, and companies have the registered valuers reports, and that constitutes an important evidence for the auditor. So as an auditor, students, your responsibilities are enormous, and you have to comply with the relevant essays. So students, you need to call sufficient and appropriate audit evidence. So this is about question number Welcome back, students, after the break. Yes, students, with me, CA Shefali Jain, who is faculty in GST. So she is there with us and she will guide you about the implications, about the intricacies of GST, which are there in the case study 5. Yes, over to you, Shefali madam.
Thank you, sir. Good evening, students. So as sir told that I am a faculty for indirect tax laws at Board of Studies. So today we'll discuss the GST aspects of this case study. In fact, in this case study, the key concepts which we will be understanding by going through the questions are the import of goods and export of goods. So provisions relating to GST pertaining to import and export of goods will be discussed. So let me share the case study with you. Hope screen is visible to all of you. My screen has been shared. Yes. So on page number 5.2, in second paragraph, GST related issues have been outlined for this particular company, ABC Limited. ABC Limited seeks help from CA Nitin on the following issues. During the year, Rahul is finding it difficult to comprehend the GST taxation with respect to export sales made by their company, ABC Limited, which are of a peculiar nature. So there are certain import transactions and certain export transactions which have been made by ABC Limited, and it is finding it difficult to understand the GST taxability or their taxability, their livability to GST with respect to the transactions which have been undertaken by ABC Limited. So before going through the transactions which ABC Limited has undertaken, we'll just have a quick overview that how import of goods and export of goods is taxed under GST. For import of goods, whenever any goods are imported by any importer from a place outside India, then on that particular transaction, the duties, the primary duties which are levied is the basic customs duty, then the additional duties of customs like anti-dumping duty, then safeguard duty or countervailing duty, and then we have the social welfare surcharge and IGST, that is integrated tax. Apart from IGST, GST compensation cess is also levied on in case of import of luxury goods or sin goods. Now, each of these taxes, basic custom duty is levied under the Customs Act. Then additional duties of customs like anti-dumping duty, countervailing duties, and then safeguard duty, they are being levied under the GST Customs Tariff Act. IGST is levied under the IGST Act 2017. Then social welfare surcharge is levied by Finance Act 2018. And GST compensation cess is levied by GST Compensation to States Act 2017. So regarding GST compensation cess, we generally do not include GST compensation cess portion in our questions. So you will generally find that the customs question, they have specific mention that you have to ignore GST compensation cess, and same is true for the GST questions also. Now, when any goods are imported into India, then apart from customs duty, IGST is levied under the IGST Act. So it is levied by the IGST Act, but the machinery for collecting the IGST is provided under the customs law, or the IGST is collected in accordance with the provisions of the Customs Tariff Act. Then, so for any tax to be levied, we should know that what is the value. Then when this tax has to be levied, what would be the rate of tax? Then we can compute that tax. So what would be the value for levying IGST? For levying IGST, the value has to be determined as per Customs Tariff Act. So for value, we have to go to Customs Tariff Act. It is levied under IGST Act. Section 5(1) of the IGST Act, proviso to that particular section, provides for the levy of IGST on import of goods. Now let me read out Section 5(1) for you. Proviso to Section 5(1) provides that the integrated tax on goods imported into India shall be levied and collected. Now, this has been levied as per IGST Act, but it shall be levied and collected in accordance with the provisions of Section 3 of the IGS, of the Customs Tariff Act 1975. That is what we had just discussed. On the value determined under the said Act on the value determined under Customs Tariff Act 1975. Now, at what point this tax will be levied? It will be levied at a point when the duties of customs are levied on such goods under Section 12 of the Customs Act 1962. Now, this tax, this IGST, will be levied on import of goods at a time when custom duties are collected. Custom duties are levied. So this will be levied on any import transaction, import of goods at the time when custom duty becomes leviable on a particular transaction. On any import of goods, custom duty becomes payable when import gets completed. When can we say that import has been completed? When the goods which are being imported, they become part of the landmass of the country. When they cross the custom barriers or they cross the custom frontiers of the country, then they are termed as that they have been imported. At that time, the custom duties are levied, and at the same time, IGST or integrated tax will also be levied. So at what time IGST will be levied on import of goods? When custom duties will be levied. Custom duties are levied when import gets completed. Now, value, we have to see Customs Tariff Act. We'll see for each of the cases how value has to be determined. Then the rate. Now, what would be the rate at which IGST would be levied on import of goods? Rate would be the rate of IGST which is applicable on supply of like articles in India. That would be the rate of IGST which is levied on import of goods also. So similar products must have been manufactured in India also. And if they are being imported from a country outside India, then the rate which is applicable on supply of that like article, same rate will apply on import of goods also. Then for export of goods. Now, as regard export of goods, the export of goods are zero rated under GST. That means when we are exporting any goods from India to a country outside India, then there are two options which are available with the exporter. They are not exempt by default. So you cannot say that any goods which are exported outside India, they will be exempt from IGST or GST leviability. No. GST is leviable on the export transactions. Only thing is that they are zero rated. Now, what do you mean by a zero rated supply? In case of a zero rated supply, either they can be exported without payment of tax under a bond or a letter of undertaking, and the refund of ITC, refund of the tax paid on inputs, would be available. So there are two legs of any transaction. One is the output tax and one is the input tax. So on any export transaction, one option available with the exporter is that he does not pay any tax on the outward liability. That means he export the goods without payment of tax, and he gets the refund of the input tax or the tax paid on the inward supplies. Other option which is available is that he clears the goods, export goods, on payment of IGST, because on export of goods also IGST is leviable. Import and export of goods are considered as interstate supplies. So on both of them, IGST is leviable. So on export of goods, IGST would be paid by the exporter. And in case of the this IGST, which he is paying at the time of import, he can utilize his ITC, which is available with him, or the tax paid on his inward supplies, he can utilize for paying whatever eligible ITC is there, that he can use for payment of the tax on outward supply or exports. And then he can claim the refund of the IGST paid on exports. So there are two ways. Either he removes goods without payment of IGST or without payment of GST and claims the refund of tax paid on inputs or inputs and input services. Or the second option is that he can clear his goods on payment of IGST and he can claim the ITC while paying this IGST on outward supplies. Then afterwards, he can claim a refund of the IGST paid on the exports. Now, this exports, the second option, that is removing the goods on payment of duty, or payment of tax, payment of IGST, is not available in case of certain notified products which have been notified. They are kind of goods like pan masala, tobacco, and related products. So for them, if a person is undertaking a transaction where he wants to pay the tax at the time of removal of goods, that option is not available to him. So this is the broad overview of import and export transactions. Now we come to the questions or the information given in the question, and we'll one by one deal that how it will be taken care of or how it will be dealt in the GST law. During the year, Rahul is finding it difficult to comprehend the GST taxation. Now, one such sale is where ABC Limited receives an order to supply goods to a dealer B in Greece. The company finds a supplier C in Singapore and asks him to supply goods to B in Greece. So what is actually happening here is that the ABC Limited has received an order to supply goods to dealer B in Greece. So it is actually, in a way, it is exporting the goods. If we till now, whatever we have understood, we might term this transaction to be an export because ABC Limited has to supply goods to B. B is located outside India in Greece, but these goods have to be supplied by another supplier in another country, that is C. So supplier C will supply these goods in Greece. C is located in Singapore. So from Singapore, goods will directly go to Greece and they will not come to India at all. So regarding invoice, how invoices have been issued, we'll see later on. The point to be noted here is that the goods do not touch Indian shores. They are shipped by sea from Singapore to B in Greece. So C of Singapore has directly shipped the goods to B of Greece, and the goods do not come to India at all. Now, how this transaction will be taken care of? This is a third party shipment. That means the goods have traveled from a country outside India to a country outside India. Though an Indian exporter is involved, that means he's exporting from one person, he's importing from another person, but the goods have never reached India. So we have just understood that export gets completed only when goods reach the landmass of India. But here the goods are not reaching the landmass of India, and goods are not moving from the Indian customs. So nowhere goods have come to India, and this transaction has been specifically mentioned or specifically excluded from the purview of supply itself by virtue of Schedule 8 and the Para 7. Now, what does this Para 7 of Schedule 3 provides? That supply of goods from a place in the non-taxable territory to another place in the non-taxable territory without such goods entering into India, such type of transactions will neither be treated as supply of goods nor as supply of services. They are termed as third country shipments. One country, that means two different countries are involved. The goods have moved from one country to another country, from one non-taxable territory to another non-taxable territory, and the goods have not touched India at all or Indian borders at all. So this way, this transaction will not be considered as supply at all in India, because this is included in Schedule 3 of the CGST Act. You know that any transaction, any activity which is covered under Schedule 3, then it is neither a supply of goods nor supply of services. It is not a supply. This transaction becomes a non-supply. Let us come to the invoice. Now, two invoices are raised here. One by company on B. That means ABC Limited has issued an invoice on B in Greece, and another by C on ABC Limited in India. So what is there is that company is ABC Limited. So ABC Limited has issued an invoice on B because ABC Limited is supplying goods to B and it is receiving goods from C. So C has issued an invoice to ABC Limited. So these two invoices are the invoices which had to be issued. That one invoice had to be issued by the person within Indian territory to non-taxable territory, and another invoice from non-taxable territory to the person in Indian territory would be issued. Second transaction is Rahul seeks Nitin's opinion on GST procedures and treatment for the following two types of export transactions, which he plans to procedure within near future. Now, first transaction we have seen was a third country shipment. Treatment we have understood that it is not a supply, so no GST would be levied on the same. Invoice, there will be two invoices which would be issued, one by the ABC Limited to B and another by C to ABC Limited. Second transaction is Rahul has purchased a license to put up a stall in textile supermarket global fair to be held at Milan, Italy. And he wishes to send his team to this fair along with their company's merchandise to be displayed over there for promotional purposes. So this is another transaction that what he has done is he wants to send his goods to Milan for promotional purposes. There is a global fair which is being conducted there, and in that fair he wants to display his items, display his goods, so that they can be promoted. His merchandise can be promoted there. So this type of transaction, now what will be the taxability of this type of transaction? Now this is, first of all, we have to see that the goods are, for any transaction, we have to see whether it is a supply per se or not. Because in the above the case which we have just discussed, it was not a supply at all. So here we have to check, first of all, whether it is a supply or not. Supply should be of some goods or services. So some goods are there that goods have moved. We are moving our goods from India to outside India. Second is, supply should be in course of furtherance of business. Yes, it is in course of furtherance of business because he wants to promote his business, promote his product. He is doing this activity. Third is, there should be some consideration. Now, whether Rahul is getting any consideration for the, or you can say the ABC Limited, these transactions are entered by ABC Limited only. So whether they are getting any consideration for removing these goods from India to outside India. So they are not getting any consideration because there is no sale contract. We have just moved the goods outside India for exhibition purpose, for displaying them in the textile supermarket global fair. But there is no contract of sale which has yet been entered. So there is no consideration. Now we know that if no consideration is there, then we have to go to Schedule 1 also for checking that whether any activity falls within the purview of Schedule 1, because then in that case that becomes supply. But here, goods sent outside India for exhibition purpose will not be considered to be falling in any of the paras, because first para is permanent transfer of goods, permanent transfer of the business assets. In case ITC has been taken on those goods. So this is not a permanent transfer. We're just moving the goods outside India. Then the supply of goods or services between the distinct persons. Now we are moving the goods outside India, but it is not to a distinct person. Third one is, it is for an exhibition, so no distinct person is involved. Supply of goods by an agent to principal or sub-principal to agent. That is also not there. Fourth was import of services from a related person or an establishment outside India in course or furtherance of business. Now we are not importing anything, we are sending goods outside India. So it is not covered in Schedule 1 also. So therefore, this particular transaction or this particular activity of sending goods outside India for exhibition is not a supply per se. When it is not a supply, so it cannot become export, it cannot become zero rated. That is very clear, like we had seen in the above case, earlier case of third country shipment. Now this is also not a supply. Let's come to the next transaction. He had heard from a dear friend that he could sell his company's products within India, but these could still be categorized as exports. He was eager to know about such circumstances. So in GST law, there are certain cases where even though the products do not cross the Indian customs, then also they are categorized as exports. There is a movement of goods within India. He is selling the goods within India, but still they would be categorized as exports. Now, which are those cases? So these are the cases of deemed exports, where it is not a case of physical export where goods are moving outside India, but the goods are treated as exports. They have been deemed to be exports. So there are specified cases which are deemed as exports by virtue of a notification, like supply to EOUs. So EOU is an export-oriented unit. All its production, manufacture, or whatever products it is selling, it has to sell outside India. To some permissible limit, it can sell in within India also, but it gets all the benefits of exports. So if any domestic unit is selling goods to an export-oriented unit, then that unit will get all the benefits of exports, and that will be treated as deemed exports. Similarly, if the goods are being sold, the gold is being sold under advance authorization, goods sold under advance authorization by a registered person, then goods sold under EPCG scheme, export promotion capital goods scheme. If it is being sold under, goods are being sold under that scheme, then that is termed as deemed exports. Now, how is deemed exports different from zero rated supply? Do we get all the benefits which are there in zero rated supply with deemed exports also? No. Under deemed exports, a person has to clear the goods on payment of tax. He has to pay GST on the goods removed under deemed exports, and he has to, what benefit is available under deemed exports is that the either supplier can get the refund of GST paid on removal of goods, or recipient can get the credit, the refund of the goods, refund of the GST paid on the purchase. So if we are selling the goods to, if we are making deemed exports, if we are selling the goods under deemed export provision, then either supplier or recipient can claim refund of the GST paid on such sales, and supplier can claim the refund only when the recipient has not claimed ITC of the GST paid on the sales of goods. This is the case. So in case of deemed exports, the goods are sold within India, but then also they are categorized as exports. So we'll see if any question is there with regard to this, but when this we'll see when we'll come to questions. So we are just reading the information given in the question and in the case study, and we are trying to analyze that what type of questions can be there. We are trying to analyze each and every statement from the purview of GST also, because it is mentioned at the beginning of this para itself that Rahul is finding it difficult to comprehend the GST taxation. So this is very apparent that these transactions have to be analyzed with regard to GST taxability. Point C provides chief accountant of the company further seeks CA Nitin's time to understand the valuation and taxability of the following transactions under GST. ABC Limited has imported a special fabric from Paris and files an ex-bond bill of entry for clearing such warehouse goods for home consumption. Now, very important transaction which is there. The goods have been warehoused. ABC Limited has imported some fabric from Paris. It has filed an ex-bond bill of entry. Now, ex-bond bill of entry means that a bill of entry has been filed for clearing the goods from the warehouse. What is the procedure of warehousing the goods when you are importing them? In case of import of goods, the importer has an option that it does not clear the goods immediately. Instead, it places these goods or it stores these goods in a warehouse, in a custom bonded warehouse. This is not his own private warehouse. It is a custom bonded warehouse where he can store the goods, he can warehouse his goods. And in that case, he does not have to pay the duty, customs duty on those goods immediately. He will pay the duty when he removes those goods from the warehouse. He has to pay the duty at that time. Or the stipulated period which is mentioned in the law, he has to pay duty at that time. But till the time he is storing his goods, he is warehousing his goods, at that time, he has to file a bond. And this bond would be triple the amount, which is of triple the amount of the duty assessed at the time of filing depositing those goods in the warehouse. Now, when a person is an importer is depositing goods in a warehouse, then he has to file an into bond bill of entry, because he is depositing his goods into the warehouse. So that is called into bond bill of entry. And at the time of filing into bond bill of entry, he has to file a bond. He has to give some security to the warehouse keeper, so that means in case of default, his duty can be recovered from that bond. But at the time of removal of the goods from the warehouse, he has to pay the computed amount of duty or the duty which has been assessed on his product. At that time, he has to file ex bond bill of entry. So when he is depositing goods into the warehouse, he files into bond bill of entry. When he clears the goods from the warehouse, he files ex bond bill of entry. And he has to pay duty when he files the ex bond bill of entry. So in this case also, ABC Limited has imported fabric and he is filing ex bond bill of entry for clearing such warehouse goods for home consumption. So that means he might have earlier warehoused those goods and he would have filed into bond bill of entry. He would not have paid any duty on any IGST, etc. on them. He would be paying them when he is clearing those goods for home consumption. Clearing goods for home consumption means he's taking goods out from warehouse and he's taking it to either his factory or his warehouse, but he is not keeping those goods in customs custody now. So what would be the levy? Now, on what value this duty or this IGST would be levied? So in case when the goods are kept in a warehouse and afterwards they are being taken out from a warehouse, then in that case, the duty which would be levied would be on the basic custom duty would be on the value which was computed under section 14 of the custom. Now I'm telling you basic custom duty also because you have to have a complete picture of the indirect tax laws. So because it's an IBS paper, so whenever any question is asked, you should know what is the applicability from the point of view of GST, from the point of view of customs duty also, because there can be a question regarding that also. So basic custom duty will be computed on the value which is computed or assessed under Section 14 of the Customs Act 1962. And this value, which was existing at the time of filing the into bond bill of entry. That means the day on which he deposited the goods into the warehouse, he filed the into bond bill of entry. That date, whatever value was there, BCD, basic custom duty, has to be paid. Rate will be taken at the time when goods were removed. So when he files ex bond bill of entry, rate will be taken of that date. Value will be of the date of the into bond bill of entry. Rate will be of ex bond bill of entry. What about IGST? IGST would be computed in this case on the assessable. Now, we had already seen that for IGST, the value has to be taken from the customs law. In Customs Tariff Act, under Section 3, the subsection 8, the manner of determination of value for the purpose of levying IGST has been provided. What it says, the assessable value of the goods under Section 14, that means the value on which BCD is levied. So assessable value plus BCD plus social welfare surcharge. Now this social welfare surcharge is levied before IGST because social welfare surcharge on IGST is exempt by virtue of a notification. So that is why social welfare surcharge is also levied. We have an assessable value as per the customs law. On that, BCD rate is applied and we compute basic custom duty. Social welfare surcharge is 10% of the basic custom duty. So that is also computed and added to the assessable value. So assessable value plus basic custom duty plus social welfare surcharge together makes the assessable value of the IGST. In this case, if certain additional customs duties like anti-dumping duty, safeguard duty, countervailing, etc., any such duty is being levied, then that duty will also be added to this value for the purpose of computing IGST. So for computing IGST, what is on import of goods? Now this is on import of goods, whatever value we are telling. So on import of goods, IGST would be computed on a value which is assessable value under Section 14 plus basic custom duty plus 10% of basic custom duty, which is social welfare surcharge. Because social welfare surcharge is levied on is not levied on IGST, so it will be levied before levying IGST. And on this value collectively, we have to levy the IGST. So whatever rate of IGST is there, rate of IGST is the rate of like article which is being supplied in India. The rate at which it is being supplied in India is the rate of IGST, which would be levied on that particular product. And that would be IGST. In case additional custom duties are also being levied, that will also be included in the value. Now, there is also a case where there is a possibility that this transaction of ABC Limited, where it has imported some goods from Paris and it has deposited them in warehouse, if ABC Limited had sold these goods, this special fabric, to some person in India before removing those goods from the warehouse. Goods were lying in the warehouse, it deposited those goods in warehouse, and when these goods were in warehouse, if ABC Limited had sold those goods to suppose vendor X, and goods have not yet been removed from the warehouse. So the question arises that whether GST would be levied on that particular transaction, that means sale of goods by ABC Limited to Mr. X when the goods were in warehouse. That means before they were cleared from the warehouse. Before they were cleared from the warehouse, the goods have been sold. In case goods had been sold by ABC Limited to some other person, Mr. X, then will it be subject to IGST? No. This transaction will not be subject to IGST. Why it will not be subject to IGST? Because as per Schedule 3, Para 8A, supply of warehoused goods to any person before clearance for home consumption. Supply of any warehouse goods to any person before clearance for home consumption is neither a supply of goods nor supply of services. So if ABC Limited sells these goods to some other person before filing ex bond bill of entry, then that transaction would not have been considered as supply. Then what would have been the leviability of IGST? Because of that transaction, IGST is not leviable. Then IGST would be levied at the time when this new person to whom ABC Limited had sold his goods, Mr. X is in our case, Mr. X would file ex bond bill of entry and IGST would be levied on the transaction value, that means the value at which ABC Limited has sold goods to Mr. X, or the value which we had just now considered, that is the assessable value under section 14 plus BCD plus and all other customs duties, that would be the value, or whichever is higher. Now these two values, transaction value or the assessable value which we just computed, whichever is higher would have been considered for the purpose of levying IGST in case of the warehouse goods sold before clearing them from the warehouse. But this transaction is not given in our case study. Please remember that this is not the case which is given here. Here it is a very simple case that the ABC Limited has imported the goods and it has warehoused those goods. Now it is removing those goods by filing export bill of entry. It is clearing those warehouse goods for home consumption. So simply this transaction would be leviable to GST, and assessable value plus BCD plus SWS and any other customs duty would be the value for the purpose of levying the IGST in this case. Next transaction. Now next transaction is ABC Limited imported textile fabric from London and sells them to a Panacea Private Limited in India. It's in India itself before the goods are cleared for home consumption. The customs declaration, that is bill of entry, etc., is filed by the agent of Panacea Private Limited for clearance of such goods. Now this is another case. Here ABC Limited imported textile fabric from London, but it did not warehouse those goods. What it did was, before clear, so whenever the goods reach the custom frontiers, then next step is to file a bill of entry, pay duty, and clear those goods from warehouse, from the customs frontiers, and you have to clear those goods for home consumption. Now, in case before clearing for home consumption, ABC Limited, now in this case, has entered into a transaction with Panacea Private Limited. It sold those goods to Panacea Private Limited before clearance for home consumption. Now, this particular transaction where the goods are supplied by a consignee before clearing those goods for home consumption, and that is not considered as supply under GST law. This is para 8B of the CGST Act, of Schedule 3 of CGST Act. Now, what does this transaction actually say? Supply of goods by the consignee to any other person by endorsement of document of title to the goods. Now, how this transaction takes place? This transaction takes place by endorsing the document of title, because the goods have not actually been transferred to Panacea Private Limited. Only the documents have been transferred after the goods have been dispatched from the port of origin located outside India, but before clearance for home consumption. This is actually termed as IC sales. So any supply of goods before these of the goods which are imported into India from a country outside India, and before these goods have been cleared for home consumption. So they have left the port of export. They have left the port of the country from which they have been exported. They have left for India, but before they could be cleared for home consumption from Indian port, they have been sold to another person. That transaction will neither be termed as export of goods nor as export of services. In fact, that will not be considered as supply at all. Okay, so in this case also, the sale of textile fabric by ABC Limited to Panacea Private Limited will not be considered as the supply at all. So this will not be supply, so there will be no GST on that transaction. That means the sale of goods by ABC Limited to Panacea Private Limited will not be subject to GST. However, when Panacea Private Limited removes the goods for home consumption, it files bill of entry, it pays the duty, then what will happen? At that time, the duty and as well as GST has to be paid. At that time, customs duty has to be paid, as well as the IGST on this transaction has to be paid. In fact, at that time, we have to pay the basic custom duty at the price at which these goods have been sold by ABC Limited to Panacea Private Limited. Okay. So in case of IC sales, the assessable value of imported goods for levying customs duty as well as IGST is determined on the basis of price paid by the last IC sales buyer. And here in our case, the last IC sale buyer is Panacea Private Limited. So when Panacea Private Limited clears these goods for home consumption, then he has to pay basic custom duty as well as IGST on the price that he has paid to ABC Limited at the time of purchasing these goods. So with this, we have understood all the transactions which have been undertaken by ABC Limited with regard to import and export of goods. So let us see the questions relating to this. First is question number 3. Question number 3 is statement 1. GST is leviable on the fabric imported from
Shefali
Paris.
madam,
Yes, sir.
Shefali madam, can I take question number 2 before that?
Yes, sir. Yes, you can take that, sir.
It is because just it will take 2-3 minutes.
Yes, sir. Sure, sir. Sure. You
Yes,
take this one.
students, about question number 2, this is direct question from intermediate level. What should CA Nitin advise CA Chris to do when the letter is stuck in the, of course it belongs to CA final also. It is not that this is not in the syllabus of CA final, but the concept is of materiality plus planning and strategy. So this is covered in chapter 2 of CA final also. What should CA Nitin advise CA Chris to do when the letter is stuck in the revision dilemma of materiality levels set earlier? So first, this is simple question, students. First, modify the overall strategy and thereafter prepare the audit plan in line with strategy. Or second option is first prepare the audit plan. As you all are aware, first auditor has to develop first he develops overall strategy and then audit plan is follows, and modify the audit plan and strategy simultaneously. Go with change in anyone as these are not interrelated. So first option from this, first option is there is the answer. If first he will modify the overall strategy and thereafter prepare the audit plan, because strategy comes first and then plan follows. So this is simple question, students. Yes, Shefali madam, you can continue with.
Okay, sir.
Yes.
Just a minute. Yes. So we were on question number 3. So first 2 questions have been taken by sir already. Now we are moving to question number 3. Question 3 provides, there are 2 statements which have been provided in this MCQ, and we have to see which all options are correct with regard to these 2 statements. Statement 1 says GST is leviable on the fabric imported from Paris while filing clearance for home consumption. In fact, while filing clearance for home consumption, a bill of entry has to be filed. So ex-bond bill of entry was filed because we know that the fabric imported from Paris was deposited in the warehouse by ABC Limited, and subsequently it filed the ex-bond bill of entry for removing those goods or for clearing those goods for home consumption. So whether GST is leviable on the fabric which was imported from Paris at the time when this bill of entry for home consumption or ex-bond bill of entry for removing the goods from warehouse for home consumption has been filed. So this statement is true, as we have already discussed that yes, GST would be leviable. So statement 1 is correct. Statement 2 says GST is not leviable on sales made to Panacea Private Limited. Yes, that is also true because the sales to Panacea Private Limited are the high sea sales or the sales made after the goods are removed from the port of export and before they are cleared for home consumption from in India. So this is sale by to Panacea Private Limited is one of such sales. Goods were imported or textile fabric was imported from London and it was sold to Panacea Private Limited in India before goods are cleared for home consumption. So it is a high sea sales, and therefore on this sales GST would not be leviable because it comes within the purview of Schedule 3 of the CGST Act, Para 8B, and this was not it is not a supply of goods, it is not a supply of services, it is actually not a supply at all. When something is not supplied, GST cannot be levied on that particular transaction. So here GST would not be levied on the sales made to Panacea Private Limited. So this makes both the statements as correct. Statement 1, GST is leviable on fabric imported from Paris. Statement 2, GST is not leviable on sales made to Panacea Private Limited. Both these statements are correct. Now let us see what are the options given to us. Option A says statement 1 is correct, but statement 2 is incorrect. So this option becomes wrong. Both these statements are correct and independent of each other. In fact, this is the correct statements. Other 2 options, statement 2 is correct, statement 1 supports statement 2. Statement 1 is correct, but statement 2 is incorrect. These two options, option C and option D, are not correct. Option B is the right answer because both the statements which are given here are correct. And they are independent of each other because one is an import transaction and one it is a sale, another one is a sale transaction, but though it is not a supply under GST. Question 4 has already been taken by Nisha madam. Now question 5. Question 5 is statement 1. In case of trade involving B in Greece and C in Singapore, invoicing should not have been done by ABC Limited in India. Now this is the first statement. That we have seen. Now, let us see these two statements and we'll go to the case again so that you can relate the statements with that. In case of the transaction which was there between B and C, so ABC Limited should not have raised any invoice. This is the first statement. Second statement says value of such shipments has to be included by ABC Limited in the value of exempt supply for the purpose of reversal of ITC under rules 42 and 43 of CGST rules. Actually, for the purpose of reversal of ITC under rules 42 and 43 of CGST rules, the explanation to these two rules, it provides the definition of exempt supply, as well as in section 17.3 also. So, exempt supply for the purpose of reversal of ITC is, in some manner, it is different. Or the definition of value of exempt supply is, in some cases or in some ways, it is different from the definition of exempt supply. Generally, what exempt supply provides, exempt supply says that a supply which is not, which is exempt, exempt supply is a supply which is exempt by way of a notification or nil rated supplies or non-taxable supplies. Okay, but something which is not a supply will not be considered as an exempt supply because it is not a supply in the first place, so it cannot be an exempt supply. However, so whatever transactions or activities are covered in Schedule 3, they are not a supply. So if I'm going by strictly by the definition of exempt supply provided under the Act, then the items there in Schedule 3, whatever paras, whatever activities or transactions are included in Schedule 3, they will not be considered as the exempt supply. However, for the purpose of reversal under rules 42 and 43, the value of exempt supply in some cases it includes the activities or transactions included in Schedule 3. For example, the sale of building. Sale of securities is there. Then the specified cases of supply of warehoused goods, notified cases, that would also be there. So this will be included in the value of exempt supply, and how this value has to be determined, that is also mentioned. But we will not go into that. It is for security, it is 1% of the value of securities for the purpose of building. It is the value which is taken for stamp duty. That is provided there. But this will be included in the value of exempt supply. However, any other item of Schedule 3 will not be included in the value of exempt supply. So only three paras, which is sale of building. Then we have the sale of securities. Sale of securities is not a supply of goods or supply of services, but because it is not included in the definition of goods and services in the first place. It is excluded from both the definitions, so it is not a supply, but it is still included by the value of exempt supply. It is not a part of Schedule 3. It is excluded from the definition itself, from the definition of goods or services. But sale of building is there in Schedule 3. Similarly, supply of warehouse goods is there in Schedule 3. These two have been expressly included in the value of exempt supply for the purpose of reversal of ITC. But the case which we are discussing here is the case of third country shipment. That is a case where the goods do not reach the Indian custom frontiers or Indian landmass at all. They do not enter India at all. So let us once again go through this transaction so that you can recall that what I was actually mentioning. Yes. So ABC Limited receives goods to order to supply goods to a dealer B in Greece. The company finds a supplier C in Singapore and asks him to supply goods to B in Greece. Two invoices are raised here. One by ABC Limited to B and second by C to ABC Limited. Now, both these invoices are correct. So ABC Limited has to issue an invoice to B because it is a supply in commercial sense. Though it is not a supply in India, but this invoice has to be raised by ABC Limited to be in Greece. That invoice is correct that they have issued that invoice. Secondly, this transaction is a third country shipment. This transaction is not a supply as per Schedule 3. So will this be included in value of exempt supply? We know that only 2 items are specifically included. So this will not be included in the value of exempt supply for the purpose of reversal under Rule 242 and 43. So these two statements which are given to us have become incorrect. Statement 1 is also incorrect. Statement 2 is also incorrect. So let us see the options. Option 1 says statement 1 is correct. Statement 2 supports statement 1, which is not correct. Both the statements are incorrect. Option 2 provides. So option B is correct. Both the statements are incorrect. Neither the value of such shipments by ABC Limited is included in the value of supply, nor the trade, in case of trade involving B in Greece and C in Singapore, the invoicing has to be done by ABC Limited. In this case, ABC Limited has to issue the invoice. It is not the case that when the goods are being supplied to B in Greece and they are supplied by B, they are supplied to B straight away by C, and in that case, the invoice has to be issued by ABC Limited in India to B. So I hope this makes this question clear to you. 6th question and 7th question have already been taken. Now we come to question number 8. Discuss the implications of proposed transaction relating to sending of company's merchandise for display in textile fair in Italy. Also discuss under what circumstances goods sold within India can still be categorized as exports under GST law, and also touch upon the taxability of such transactions under GST law. This question actually we had done in detail when we were discussing that particular transaction at the time of analysis of the case study. But we'll once again go through the answer which is provided here, which will remind you that yes, we have already discussed it. First of all, the export of services is an interstate supply and exports are zero rated. We had already done. So we had discussed the two options which are available, either to pay the IGST at the time of making exports and utilize ITC for paying this IGST and claim the refund of this IGST. Second option is remove the goods without payment of duty. So making exports without payment of duty and claiming refund of the input tax credit. This is the second option. Now, the transfer of the goods by Rahul to Milan, the transfer of goods to Milan is not a supply transaction in the first place. Why? Because it is an activity without consideration, it does not fall under Schedule 1. Therefore, it does not constitute supply at all. Since it is not a supply, it cannot be a zero-rated supply, and therefore, the execution of the bond is also not required, because execution of bond is required only in case of zero-rated supply. We have seen that in case of zero-rated supply, the goods can be exported without payment of tax at the time of removing those goods. Only a bond has to be furnished, or a letter of undertaking has to be furnished. In this case, since it is not a supply transaction, it is not a zero-rated supply, this furnishing of bond is not required. Now, when it becomes supply, just for the information purpose, though it is not required in this answer, when the goods, now these goods are actually the goods sold on sale or return basis, or goods supplied on sale or return basis. That means these goods can be sold in that exhibition, or these goods can come straight away back to the country, or straight away to the exporter without being sold. Why? Because no sales transaction materialized there. So this could also be a case. So on sale or return basis, any goods, if they are supplied, how do we determine the time of supply? It is either the actual sale transaction when it has materialized, or 6 months, whichever is earlier. So if any sale transaction materializes, or if any sale fructifies till 6 months from the removal of such goods, then they will be considered as supply. And in case they are not, they will be considered, that transaction will become supply, and tax will be paid on that. And in case it is not removed, it is not sold within 6 months, then at the end of, and they do not come back, these goods which have been supplied or which have been removed outside India, if they do not come back to India, they are not returned to India within 6 months, then on the expiry of 6 months, this transaction will be considered as sale. If before 6 months, without sale being fructifying, without sale being materializing, the goods are returned to India, goods are taken back into India, then there will be no sale transaction, no supply. But in case any supply transaction is materialized, then that will be the date of supply. If no supply transaction materializes, goods do not return back to India, then the 6 months from the date of their removal will be considered as their supply. It will be considered as the time of their supply, and GST has to, and they will come, then they will be considered as export of goods. Even though in that case, bond has not been furnished, because when they were being removed, no bond was furnished. This is the condition which is not required to be fulfilled, since these goods are not a zero rated supply at the time of their removal. Then, as regards selling the goods within India and categorizing them as exports, we have seen the deemed export clauses. We have already discussed them in detail. And for deemed exports, the taxability also we have seen that they will not be taxed as zero rated supplies. They will be normal. They will be like normal supplies. They will be subject to taxes. And on these taxes, the refund can be claimed either by the supplier or recipient. Only thing is the supplier has to ensure that recipient does not claim ITC on the tax paid by him at the time of sale. Okay. So with this, all the questions we have taken with regard to GST and other subjects in this case study, and we have come to the end of discussion of this case study. So in case you have any questions, you can ask the questions. Otherwise, we can wind up the session. We'll wait for 1 more minute for the queries. So students, if you have any query, you can ask regarding this case study pertaining to GST. All the questions have been taken. Concept has already been discussed with you. So I think no queries are there with regard to the case study now. So with this, we come to an end of the session. I hope you enjoyed the session and you understood the concepts of various subjects which have been discussed in this case study. And with this, we come to an end of the session. Thanks for the patient listening. Thank you. Yes. ओवर हो गया? हाँ मैम, सर कर दिया फिर मैंने वाइंड अप,
ठीक है,
क्योंकि
ठीक है। थैंक यू,
आपने
थैंक यू।
याद है ना बीच में